Thank you, everybody, for joining us today for this event. I guess this webinar on the tax changes and specifically the federal budget, but specifically tax changes. Wanted to give the members an opportunity to kind of hear from one of our partners, BDO, and Paul Walker in particular, who's been an instrumental partner for us in preparing to address some of the changes that many of you, of course, were aware of and concerned with that had happened over the summer last year. And Paul was actually quite instrumental in helping our policy committee to work through some of the complexity in those policy recommendations at that time, and actually trying to help us figure out how to respond in an intelligent way back to the government. What some of you may have seen, and it is posted on our website under policy, was that we were able to put together a response to the consultation period in the summer. We put that response in September, and that really led to a very engaged dialogue with the government between NACO and other industry associations that represented investors who are going to be impacted by these changes. And I have to say, while obviously any change is always going to have some negative consequences, I think that we were really impressed in terms of the government's willingness to listen, willingness to kind of admit that there might have been some unintended consequences and work with us to try to address them. And so, we want to now give a chance to Paul Walker to have some time to kind of review some of the highlights from the budget. And then what I want to do is actually go into some more in-depth discussion around the tax changes and other policy items that were included in the budget that might affect angel investors. There's a few pieces in there that will have impact on us. And then from there on, I want to just take some questions from some of the participants to kind of see if there's any specific questions that we could answer for you. Paul, do you want to start with just kind of an overview of who you are, what you were doing with regards to this budget, and then your highlights in terms of BDO's insights on how this budget affected not only angels, I guess, but rather the ecosystem of innovation, because obviously our members are investing in startups.
Okay, so thanks, Yuri. I appreciate this. As you know, my name is Paul Walker. I'm a senior tax manager in the group here at BDO. I help lead up the tax side of our TLS agenda, or our technology and life sciences, and I'm the GTA tax leader for that group. My main focus in clients is working with startup companies, scale-up companies, and companies that reach mature stage, and spend a lot of time in structuring companies from tax perspectives, and also helping companies eventually exit or go to the next transition of either IPO or wherever the companies go. So I spend a lot of time in various places within the GTA landscape, spend some time at Communitech and other type innovation centers, and work with a lot of these great companies. And I do work with a number of angels as well in the area on some of the planning that they do. So from a budget perspective, and what I'll do first is I'll walk through the highlights of the budget and give some opinions or some thoughts of what we see and how we interpret. But the budget itself, I think, was very limited when it came to tax changes. But it was very specifically focused, and what I would say, it was very politically focused, given the timing and the pending elections coming up in 2019. What this budget was, which is different from last year's budget. Last year's budget was really focused on innovation, which was all good for the technology space. This year, the budget was highly focused on equality and gender equality specifically, and also highlighted those at risk that have had other identifiable differences that are also women. And I think the budget did a good job of actually walking through a lot of that, which I would personally say having, I think is very welcomed agenda by the government. Although I would stress that it still is a little bit politically focused. What the government's focus on the equality, and I'll just go through a couple of points here, is the focus here is that they believe that based on facts, and they've got a lot of stats and they've got a lot of cited reports to back it up, that in most situations, women are paid 30% less than men. So what they're stating here is that there's a huge gap. And what they're also stating is that there's barriers to women entering the workforce, even if they're fully educated in the field of study where they would enter. And their founding position, or their top-reaching statement, is that companies would grow and the economy grows as women join the workforce and are part of the workforce with different views and initiatives. And it's their view that tackling this issue will drive the economy. It would also drive the economy in needed labor, as opposed to, I would assume, immigration and things in that nature. And they've specifically stated that there is a large gap in the STEM fields, so that would impact specifically our industry and the technology space. The second, not the biggest point of it, but they talked about growth, and growth within women, gender gap is one, but they talked about innovation. Innovation was not really a full focus of the budget, although they did provide some platforms for funding and listed out that funding today and over a period of time. But the focus was mainly on scientists and researchers and in academia. There was no focus on NAFTA in regards to innovation. The key piece that they lay out here was consolidating a better delivery, a better way that companies and those in the ecosystem can approach the innovation funding, and laid it out on a 4-level type platform, being IRAP, Strategic Investment Fund, the Canadian Trade Commission, and helping companies go global, and regional development agencies. And in the regional development agencies is where they're focusing money specifically for women entrepreneurs. I would say that this focus is really good for startup, and specifically identifying the scale-up space, early scale-up space. But from my view and reading the document, I think it still lacks some focus on the mid to mature scale-up side, and there's been many that have recently commented on that, and whether or not the government's got to focus on building legacy Canada and not just IP that will eventually leave Canada, go offshore, along with the talent and the jobs. Things that were missing that we think is not in the right path is response to U.S. Tax reforms. And this would be U.S. tax reforms, and by way of Canada looking at reducing personal tax rates or reducing corporate tax rates, which I think on the government side is a little bit unpopular right now. But there's things that they could have addressed that the U.S. tax reform has, things like expensing capital items that the U.S. has proposed and has passed, where we still have our depreciation mechanisms, and looking at having more investment in startups and focus looking at how we get to the U.S., how we're not shifting talent to the U.S., and we're not shifting businesses. I can say since U.S. tax reform, I've had a number of clients and non-clients looking at how would they exit from Canada and bring their wealth outside to the U.S., their talent, their businesses, and their IP. So that's becoming an ongoing conversation. Again, there was no specifics with NAFTA, although I will say that they did talk about treaties with tax treaties and free trade agreement treaties with the Asian countries, and also working with China, which is helpful. The business measures that they put in place were, as we all know, and we're going to talk about, is the passive investment rules. They looked at eliminating and streamlining health and welfare trust. They are making changes to the at-risk amounts on tiered partnerships to limit the ability to have partners utilize losses when they don't have at-risk amounts within those partnerships. They also offshore changes to what they call closed loopholes on monies not coming into Canada through equity-based financial arrangements. They're also looking at increasing the disclosure, and I assume this comes with the private company proposals, but really looking at who are the members of trusts and ensuring that trust filing and disclosures are done similar to other entities where we will disclose trustees, settlers, beneficiaries, and provide that in the reporting. Something of interest, there's controlled foreign affiliate reporting, which is something that's usually due within 15 months to give you time to look at financial statements, and that of your foreign entities, that's now going to be due within 6 months of the regular filing period for corporate tax returns. I think that was about really everything that was in the budget. As a highlight, I would note that we do have an on-demand webinar that does walk through some of this, but specifically walks through the changes in the passive income rules. And we have a number of our budget documents on our website. And Yuri, that's the highlights that we have from the budget.
Fantastic. Thanks a lot, Paul, for the highlights on that. And I think from NACO's standpoint, I mean, that very much aligns with our own kind of analysis on it. As some of the members may be aware, I was at the lockup at the budget last week and had the chance to kind of speak with the staff at the Ministry of Finance and the other ministries about some of the initiatives. And from our point of view, the key one, obviously, and the one that we were really trying to align around and make sure we were able to kind of help the government move away from was the policy that they were looking at initially over the summer around the treatment of the dividend tax credit and the capital gains credit exemptions in relation to making investments through corporations. And from our point of view, I mean, that was definitely a positive that they actually seem to have moved entirely away from that, more or less, at least as it relates to kind of smaller businesses and corporations that are being set up for the purposes of investment. I know in BC, for example, there's quite a bit of those, and so that was an important accomplishment from our point of view. But there was other things that were also important to us in the budget. So you mentioned the access to funding and programs for the ecosystem, whether that be entrepreneurs, accelerators, incubators, or angels. The kind of alignment, the efforts to align the regional development agencies is a very important one, and one that NACO has actually been very much supportive of over the last few years as the government kind of moves to execute on that ministerial mandate. And then finally, Startup Visa being another important program for us that we support, of course, both on the incubator stream, accelerator stream, and on the angel stream. And seeing that that program is coming to a final kind of permanent program, but also seeing some funding allocated to it was a positive. And so, I mean, I guess on that point, there's been a few questions that have come up around some of the scenarios, starting with tax program. There's some confusion, I think, generally about how this is being structured and whether it's actually a good thing or not. A lot of the questions that I've been hearing relate to, essentially what actually is happening here. So before we were talking about a 76% tax in some scenarios where you made investments through a corporation. A lot of the advocacy that NACO did around this was to say that if you were going to do that, ideally you wouldn't do that, but if you're going to do that, there should be a way to exempt angel investment corporations and even reduce the impact on active corporations that were making angel investments through the corporations. I think in a way, that's kind of what the government tried to do here with the separating of active and passive income within those corporations, but still kind of tying the, I guess, penalty around investment that they're looking to enact here to strictly the active income on the basis of trigger that's really related to passive investment income. And so I don't know if you're able to kind of walk us through those changes in a little bit more detail and for the benefit of the members and help us to understand those changes.
Sure. So what I would say is that although when we talk tax language, this actually seems very straightforward. It's very welcomed legislation compared to what we were thinking where we were going to go. It has added a small layer of additional pools to track and some mechanisms there. Changing the fundamentals of integration in certain cases, but aligning integration between corporate and personal tax, probably in the right way to have integration as it was intended. So from a tax perspective, for tax people looking at these actually do appear to be very straightforward. I will make a note that some of the exceptions that they have in here when we get into talking about connected corporations, I think is good for angels, but might be limiting, and we'll talk about that for a bit as well. But what in basic ways, what they've done is if they've allowed this ability to save $1 million in up to $1 million of passive assets within a company, and assuming a 5% return is how they get to this $50,000 mark. And they're saying what they're saying is that $50,000 of passive investment income is okay, and anything above that, they find it offensive that you're saving money inside a private corporation. So they're finding ways to discourage that or to provide a penalty for doing so. And what we had seen before was talk about not just the small business rate, but the overall corporate tax rate versus personal rate, and the fact that income earned even at the normal high business rate of 26.5% is still a deferral opportunity for private corporations, and they were trying to hammer that difference between 26.5% and the 53% in Ontario personal tax rate, top part personal rate. But what they've backed off on is just the difference between the small business rate and the corporate general rate of 26.5%. So anything above that, they don't seem to have a problem with. It is the funds that you're earning when you're also being provided the small business deduction, lower 15.5% rate in Ontario. So that's their focus, which is, I would say, is a welcome focus because it isolates specific Canadian-controlled private corporations and not that of a general business population. And the way that they're going about this is by doing a two-rule change. The first is limiting the small business deduction availability, and the second is changing the refundable dividend tax on hand mechanism to better align it to the income that's being generated that creates that dividend refundable tax. So I'll go through the first one, but actually, I'll step back for a second here, just on the $50,000 test, and I would welcome some comments on this as well. It's good that they put the $50,000 million mark there, and that's really to proxy retirement savings or downturns or parental leaves and things in that nature, or sick leaves to help out business owners. But what I think they may have failed to recognize, or they recognize, is that situations where you have multiple shareholders all fully invested in a corporation, and whether it's $1 million per person or $50,000 per shareholder, as opposed to overall in the company. And I'll leave that as something in the air, and something that maybe would be a conversation with finance down the road. So the first test in passive income that they've changed is limiting the small business deduction, and this will start in years after taxation years that end after 2018. So we've got a bit of time to look at what companies are doing for this current year. And to restrict this amount, it's restricting the small business deduction, or the small business rate for Canadian-controlled private corporations when that Canadian-controlled private corporation earns more than $50,000 in passive income. So $50,000 is okay, but anything more than $50,000 all the way up to $150,000 will slowly grind the benefit of the small business deduction tax rate and put you into the 26.5% tax rate. So that's a 5-to-1 difference that will slowly grind the credit, or slowly grind the small business deduction to zero. What the key here is that they haven't changed anything in the legislation around all the other mechanisms within the Tax Act. It's just specifically focused to this one item of changing the $50,000 to $150,000 to grind limit. So it's specifically directed towards that. So it doesn't change the test of small corporations being considered large when they have over 10 million to 15 million of taxable capital. And it doesn't change the aggregate investment income stream. So there are always going to be two pools of income in companies. You have business and operating income, and you could have investment income. And they haven't changed the identification of those that income at all between investment income and operating income. And in fact, there's still a position that a taxpayer can take where they have incidental income, or what we would think is investment income, but it's part of their active business and would be tied to their active business and would not be considered passive income in any regard. What they have done is they've created a new term called adjusted aggregate investment income. So they're taking the historic investment income rules, and then they're adding or deducting certain things to come up to a new test of adjusted aggregate income to test whether or not that income is $50,000 or more to be able to grind the limit. So none of the rules change. It's just specifically that that feature that they're putting in. In general terms, your aggregate investment income is where your starting point is, and that's what it is. So if you have $50,000 there, but then they do some adjustments to get to the adjusted. So they will reduce your aggregate investment income for assets that you would have sold in the business, which would create a capital gains, which create this investment income. So they'll reduce it for active business assets sold. And they'll also reduce it for sale of shares of another Canadian-controlled private corporation that is connected to the corporation. And they use the small business corporate test, which is an existing test in the Tax Act, which means that all or substantially all of the fair market value of the assets, so we're not considering liabilities, we're looking at gross assets, including goodwill, that would be used 50% or more in active business, 50% or more in Canada. So that's a well-stated test. It's a well documented test, and it's been through the courts many times. So they're not changing the perspective of that view of what would be a qualified share of a small business corporation. And they haven't changed or modified the word connected, and it's going to exist within 186 of the Income Tax Act, and will remain the original connected corporation. It's the 10% of votes of value greater than 10% test. Also, the things that they will look at is they will increase the aggregate investment income for dividends from non-connected corporations, and get that dollar amount of $50,000 or more to then look at grinding the small business deduction. So all in all, it's complex in the way that the rules already exist, but complex now in adding this other test. But all in all, it's easily stated: if you make more than $50,000 of investment income, then your ability to utilize the small business deduction will be ground down at a 5 ratio.
Yeah, and just to provide clarity on that, my understanding is that the portion, so yes, the small business tax really relates to active business income, so operational income, or situations where you own, I guess, enough of another corporation that it triggers the active qualification.
Yep.
But it doesn't really affect the passive income in and of itself. And so I think one of the things that they were trying to do, and I'd love your input on whether they were successful at this. One of the things they're trying to do is to say that basically, if you're an angel investor and you've done a bunch of deals where, you know, your exits are all coming back and none of them are above 10%, and you don't have any active operating income, so you're not also consulting out of that business or selling services out of that business, then essentially there is no impact from this rule.
It's a mechanism of the test. You're still impacted by the rule. You're still within the test. I know people talk about carving. They're not part of the test, but they are. But you're right. It doesn't impact because they don't have any. They don't have any active business income to grind. So they're going to be at the capital gains rates, which will passive, which will create dividend tax credits. Refundable tax, so prepaid tax at 50.1% is the overall tax rate in Ontario. So it's approximating as close to the personal tax rate. But when you go to pay that money out, it comes down to what is made up of that income in the corporation, which we'll get to the second test. And there's some ordering rules of what you can pay out. So not only do we have the passive test, which I agree won't apply in this situation, you won't get a grind, but there are the now RD2H rules, which will impact the eventual payout of that money to a shareholder.
No, if it's the RD2H, does that only affect larger businesses, or have they been clear enough on that, I guess? Well, kind of so they said they intended to do. Maybe this is one of those things that we should focus on for future consultations. But one of the things they said they intended to do was to not impact smaller businesses, only larger businesses, as in regards to the RD2H rule.
I would say yes and no. Really what they're doing here, and I'm going to step back to where does RD2H come from? And an RD2H is a refundable tax that's paid on earning investment income, passive income. So when we're talking about passive income and the passive income test, that's where RD2H comes from. It's the prepaid tax that you would pay on investment income. Where the arbitrage was where you would also have active income, and active income which would be greater than $500,000, and that's where you're coming with the, it doesn't impact smaller businesses that make under 500, but it's the active business income that's taxed at the higher rates, creates what we call GRIP, or general rate income pool, and GRIP can be paid out by way of eligible dividends, and there was no mechanism to say that there was a problem paying out an eligible dividend on income that was otherwise earned that created refundable dividend tax on hand. And so you could pay out an eligible dividend and pay eligible dividend rates, which are lower than non-eligible dividend rates, on income that was earned that created RD2H, and have an RD2H refund, which gave you some savings in the overall integration. And what they've done is they've aligned it now and saying that you can't pay out eligible dividends when you have a refundable dividend tax on hand balance, because that balance was created by passive assets. So what they're doing here is they're putting an ordering rule that you have to pay out non-eligible dividends until you complete your RD2H balances, and then you can pay out eligible dividends. What this legislation hasn't done, it hasn't changed the concept of general rate income pool, or what we would call low rate income pool, which doesn't impact Canadian controlled private businesses, because that concept does not exist until they change status. But it really is impacting people's ability to pay out eligible and get this dividend refund. So they're aligning those two pools.
Okay. Okay, well, I guess, beyond that, that's one of the main areas that we wanted to discuss in regards to this tax changes. I guess the two pieces, the way that they're approaching the small business tax kind of grind down, and then the RD2H actually was the other piece that I wanted to talk on. So we kind of went right into that, which is great. And then, beyond that, I mean, the two other things I would highlight is, there does seem to be a lot of appetite to work with the angel investor community through this alignment that's happening at the regional development agency level. So, essentially, at this point in time, all they really said in the budget was that they're looking at ways of aligning the kind of various economic development agencies that they have in the government, but all of them have essentially received significant new funding. And with the purpose of that funding really be to align with the innovation agenda, essentially. And so that's code for stuff that has to do with startups and angel investors, incubators, accelerators, et cetera. And then really what they're trying to do is figure out a way to align. So there's an ongoing review with the economic development agencies of the government to figure out how to better align these things. You talked a little bit already about how they're basically trying to stratify them a little bit to kind of make sure there's a clearer role in terms of who's playing what role. But beyond that stratification, even within the regional development agency, for example, they're trying to get them to be more collaborative and more coordinated on some programming. So what my understanding of what this means is really there's a bit of work still to be done on figuring out what these programs might look like and what comes first, second, and third. But the intent is to improve deployment of these programs to ensure that they're a little bit more consistent and ultimately what that means is hopefully some kind of operational efficiency at the government level, a better client experience at the kind of recipient level, whether that's angel groups, accelerators, incubators, or startups, and then more consistent. And this is one of the key areas that they're really focused on: is more consistent collection of data from these programs across government in order to kind of make better decisions, et cetera. So, I mean, that's one area that I just wanted to give that context to anybody who kind of was wondering what that all meant. And then on the startup visa program, we're still kind of working through it, but sorry, go ahead. Okay, I thought you wanted to say something. And then on the startup visa program, really what we're hearing is that now there's some funding. We're having to determine how that funding is going to be used, essentially. But the idea going into this was essentially to support in some way the organizations that are really spending all the upfront time and energy to support these companies that are trying to come into Canada, whether that be the incubators, accelerators, the angels, or the VCs, essentially. So there's still work to be done on that as well, but these are things again that are focused on trying to align some of the programming with what's actually happening in the ecosystem, essentially. I guess at this point in time, we can go to questions. Caroline, I know you're there. Can you advise in terms of whether there's any questions or how to look at that?
At the moment, we actually have not had any questions. We had one comment that they would like some information shared afterwards. So I suggested that we would put together some brief information for people to review post-webinar. But further than that, no questions that have been submitted.
Okay. Well, if anybody's interested in clarifying some additional points, please do so. Paul, if you're open to it, maybe we can put together a quick slide deck on some of these highlights that you mentioned, and send it out to members afterwards.
Yep. The only last point I'll leave you with, Yuri, just on a practical standpoint, and there's an example in the budget document, and it talks about the connected corp, and in the example they talk about an entrepreneur that wants to fund and help out or be an angel investor in a startup and puts in 20% ownership, and they talk about the capital gain earned on that investment would not fall in these rules and would not cause a grind to the small business deduction. And what I would leave you on this one is it's a greater than 10% rule that the government's put in for companies in that situation where they want to invest into other startups or small businesses. Where I would say for your group to look at potential future changes is that angel investors usually are not investing more than 10% if they're investing out of their operating businesses. If it's just a holdco or something that's not creating active business, then we might not care. But where you're investing out of your small business, you would have a potential grind to your small business deduction if you own less than 10% and sold those shares. And where a argument could be made is that angel investing is a little bit different in that you're investing with other people to make up that 10% or 20% or whatever the case may be, and it does put you still at a disadvantage if you're under 10%, because that would be considered a passive investment, passive income. So I just leave that there, Yuri. It's something that you guys can consider as a team.
Yeah, and I guess one of the points that you brought up that was really good was something for clarification later. If the corporation is essentially kind of like a VCC where there are 10 shareholders of the corporation, is it the corporation that needs to have 10% in order for this to be an active investment, or is it the individuals themselves? So that's something definitely worth clarifying with the government. But yeah, that's definitely one of the examples, I guess, I've been getting a lot of questions at, and actually, frankly, that stood out to me at the event, and that's where I was trying to get some clarification from them around RTD and the 10% rule. But yeah, it seems that that's their intent, is essentially to try to exempt in a certain way any new taxation of angels who are making kind of smaller investments that are not active. Where this gets really complicated, and this is one of the things that I kind of advise back to the government, is that where it gets really complicated is, sometimes angels might make an investment where they, at the time of investment, own more than 10% of the company, but perhaps at the end of the investment, when they exit, might own significantly less than 10% of the company. This is quite common among angel investors. And so the real challenge is in those scenarios, you're, as an angel, you're making investments and you're not really kind of making the investments with tax optimization as the first goal. And what could end up happening is where you get a scenario that some exits are above 10% and therefore active businesses, and some investments are below 10% and therefore passive businesses, and you get this strange kind of taxation issue happening that you can't really predict, or may not have power over, because as we all know, as angel investors, it's not always entirely up to you to decide how much ownership of the company you have at the end. Sometimes it may be about follow-on investment, but in some cases you may not even have that opportunity. So in any case, that's something that I do want to work on, and love your help in that, Paul, as well.
Okay. No, that's very well put.
I do have a question here. It's not directly related to tax, but wondering about if there's any more information on direct funding vehicles. So for example, the VCCI Stream 2, funds to support startup visa program, etc.
Yeah, so at this point in time, we're trying to get clarity on the startup visa program. There was it was kind of funny. It was pointed out to me yesterday that in the budget, it said that there was $4.6 million being allocated to startup visa, with the goal of collaborating with angels and VCs and the partners in the startup visa program, but also with the goal of setting up an automated system and also improving client experience, which is kind of difficult to understand what that actually means. And I know from our end what was proposed, but it's difficult to understand from that language what exactly it means from a practical standpoint in terms of what did get funded and what didn't get funded and that kind of thing. Because as with many things, the full amount of funding requested wasn't actually fully funded. And so that's something that we're going to be working with the government to try to sort out. What is interesting about it is that there definitely is new funding available, which never was there before. So that's a positive overall. And we're trying to figure out how much of that is going to essentially end up being used to help the angels and the incubators and accelerators that are essentially doing a lot of the grunt work in the program. So that's something we still have to figure out. With regards to VCCI, so that the applications for that, for the initial kind of request for proposals was, just the initial kind of overviews just closed, I think, the day before the budget. So that's still just being reviewed now, and there isn't much more to be said on that at this time. But that's kind of separate, I think, from really anything that was announced in the budget, because that was really announced in the last budget. Is that fair to say, Paul?
Yep. Sorry.
Very cool. Yeah. So, I mean, those are the two things. I think direct funding vehicles, it's kind of TBD because a lot of the funding that was given to the regional development agencies and organizations like FedDev and CanNor, who were specifically itemized in the budget, those were really big numbers that were put out. There's a lot of detail in the background into what those numbers fund and what the proposals were that came forward. But what I can say is that in all cases, the proposals included some version of coordination and support for angel community. So again, like with Startup Visa, it's a matter now of working with the government to figure out what the next steps are and what's funding what and that kind of stuff. How the money is going to be allocated and what the timelines look like, essentially. If there are no other questions, anything else you want to say, Paul, just as a closing thought or anything like that?
No, Deb, thanks for the opportunity. Appreciate it, for sure. Thanks.
Yeah, no worries. One thing I will say to any members on the call right now is that we are, of course, working with the government on now the consultation phase with regards to these proposals, and I encourage any members that have questions or can foresee being impacted in some way by these proposals to come forward and let us know at NACO. I think you can send that to policy@nacocanada.com, but also directly to Caroline as well if you have any such examples, or to my attention. I will be coordinating with BDO on kind of trying to think through these things a little bit more clearly in the next few weeks, and at some point in time, there will be an opportunity to have some feedback to the government on these policy changes and on the budget itself. And so, please feel free to send those to us, and we'll work with you to kind of work through the examples and problems and questions. Beyond that, I think that there may be also some opportunities to consult directly with the government, and so we'll get back to members as those opportunities become more clear.
Great. Thank you everyone for joining, and this will be posted on our website following in the following coming days.
Okay, thanks a lot everybody for joining, and thanks Caroline for organizing everything. Thanks Paul for jumping on the call and helping us figure out kind of what this all means for us.
Wonderful.
Okay, bye.